NBC TV 18, celebrating 15 years of leadership.
The government tables a constitutional amendment bill for the GST in the Lok Sabha. Finance Minister Arun Jaitley reassures states, says their concerns have been accommodated and no state will lose money, as the centre will compensate states for the initial losses. The midterm economic review paints a muted picture for growth. Chief Economic Advisor says sentiment has turned around, but private investment yet to pick up. Government reiterates commitment to 4.1% fiscal deficit, but concedes it will be on the back of expenditure cuts as tax collections will miss estimates. Markets end the week on a positive note in step with a global rally. The Nifty up 1%, closing above 8,200. Mid-caps in a slightly lower gear, with the mid-cap index rising 0.5%. The rupee weakens further to 63.29 to the dollar. A panel of secretaries tells CNBC TV 18 that touching the 8% growth mark is a tall task unless manufacturing picks up, as the pessimism regarding exports is unwarranted. In a positive move for transfer pricing, the CBDT signs its first bilateral advance pricing agreement with Japan. The agreement is signed a year and a half after negotiations first began. Indian Aviation's latest player, Vistara, all set to give Jet Airways and Air India a run for their money. The airline, which takes to the skies on the 9th of January, will begin with Delhi to Mumbai and Delhi to Ahmedabad flights.
The leave be granted to introduce the bill. Those in favor may say aye. Those against may say no. I think the ayes have it, the ayes have it. The leave is granted. The minister may introduce the bill.
Sir, I introduce the bill. Provided more than an adequate protection to all states.
If this compensation can be worked out, on board.
Sir, that in the initial years, any loss of revenue as far as any state is concerned will be compensated. And we'll probably take it up in the next section itself as far as passage is concerned.
We told you so, and it is now official. There you have it, Nenta. The next session of Parliament, that's the budget session, will see the lower house take up the GST constitutional amendment bill for passage, and hopefully the Rajya Sabha will also do so. Right, Shireen? And you know, this will be vital if the long-awaited tax reform actually becomes a reality, keeping the timeline on April 1st, 2016. Lok Sabha is not going to be difficult. Real test in Rajya Sabha, and then all the back-end work still has to be done. Absolutely, a lot of back-end work, but the most ambitious tax reform making its way to Parliament, the GST Constitutional Amendment Bill, has been tabled. Of course, the reality will still be a while away, but with Lok Sabha just 2 days to go for the current session of the Parliament, this was something that the government was keen on doing. But let's talk about the markets first, because the pullback there continued for the second day running. Now, this was in line with global peers, the Nifty jumping past the 8,250 mark intraday, though it finally closed below that mark at 8,225. That's still a 65-point upside there for the Nifty. The Sensex shut shop 245 points higher at 27,371. It came off its intraday high. The mid-cap index gained about 0.5% or so. Let's go across to Anuj now. He joins us with the market action. Anuj, a very choppy, a very volatile week, ending on a positive note.
A very choppy week, in fact so choppy that by the end of the week the Sensex was up 5 points, but really it moved about 1,500 points in a matter of a week. So it was all over the place really, and the bulls would believe that the worst is over. At least they would like to believe that the worst is over with the last 2 days and the way the market stabilized. Though today, towards the end, the mid-caps lost quite a bit, and even the Nifty actually did not manage to stay above 80 to 50, so that still keeps bears in the game. Let's talk about the stocks then, which led the market today. On top were the three heavyweights that supported the market the most: ICICI Bank, Reliance and Larsen & Toubro. The three pillars of the market today, they were all up by about 2% or so. IT stocks did well after Accenture's numbers and the better outlook from the company. So you had stocks like Infosys, TCS, Wipro all gaining close to 2%. Some other prominent Nifty winners included Power Grid, Hindalco and Coal India. So High Beta was doing relatively well today. On the losing side, one stock is putting quite a bit of pressure on the market now. ITC, that was again down 1.5% today, and DLF and Asian Paints were other big losers. In terms of mid-caps, let's start with losers first, because towards the end, the market cooled off a bit in the mid-cap side. Monte Carlo didn't have a good listing, down 12%. Lanco Infra was down 6%, and Wakaranji Software was down 16%. On the winning side, though, of course, there were some big stunning moves, like SpiceJet, which was circuit up at one time. That stock was up 20%, NCC 11%, and JK Tyre up 10%. So next week is a truncated week. We have expiry on Wednesday, so let's see how it goes. For now, the bulls believe that the burst is over, but the bears believe that they're still in the game.
All right, Anush, thanks very much for joining us. You have a good weekend. Speaking of the markets, William Buiter, Citigroup's chief economist, says India is back on the reform track and expects the country to clock 6% growth in the next year. Speaking with CNBC TV 18, he said he expects the positive momentum in India to continue. Listen in.
India is back on the path of reform. And so the supply-side bottlenecks that have kept down India's growth from the levels it could aspire to, which is actually in double digits, if the necessary supply-side reforms, labor markets, FDI, infrastructure, if that were all implemented, I think we'll do it incrementally, and so the effect will not be as good as it could be, but it will definitely be better than it was. So we see growth next year in the 6% range. India did better, of course, in 2014 than in 2013, and I expect that this momentum will be maintained. We've got very sound monetary and exchange rate management. We've got better fiscal management than we had.
Well, that's the Citi view, continues to be bullish on India. In the currency space, the rupee ending low at 63.29 to the dollar against 63.11. That was the level yesterday. Now, this is the big story. The blockbuster reforms move. The goods and services tax took a significant step closer to reality, with the finance minister tabling the constitutional amendment bill in the Lok Sabha today. CNBC TV 18 brings you the fine print and the highlights.
We have made sure that no state will lose a rupee of revenue. It will be a win-win situation where they will gain revenue.
That's the finance minister tabling the 122nd constitutional amendment that seeks to lay the framework for the goods and services tax. At the core of the GST bill lies the GST Council. The Council will have 8 primary responsibilities, which include recommending goods that are exempt or subsumed within the GST, recommending rates and special rates, the threshold limit for imposing the GST, as well as recommendations on GST-related laws and the principles of levy. The GST Council will be chaired by the Union Finance Minister and will have the Minister of State for Finance as well as State Finance Ministers as members. The Vice Chairman will be elected from within the members. The GST Council decisions will require a quorum of 50% and a nod from 3/4 of the members' majority will be required for finalizing decisions. The GST Council will be formed within 60 days of passing the bill. Compensation arising out of GST was a major roadblock, and the bill assures states that the centre will compensate losses for 5 years.
This additional tax is intended to cover up for the loss during the transitory period. It has a sunset clause of 2 years.
Moreover, an additional levy of 1% will be imposed on interstate movement of goods. Collections from interstate levy will be given to states for a period of 2 years.
In the first 5 years, any loss will be compensated to the extent of 100% in the first year, 75% first 3 years, 75% in the 4th year, and 50% in the 5th year. And all decisions require a 75% vote to be cleared. So the majority of the states can't push a decision, the centre alone can't push a decision, but the two collectively can push a decision.
With the Congress, Biju Janata Dal and the AIADMK demanding that the bill be sent to a standing committee, the demand was rejected. It now remains to be seen if the NDA government will be able to push the key legislation in both houses of parliament in the budget session. In New Delhi with Ritupurna Bhuyan, this is Shireen Bhan.
So, momentous day for the Indian economy. The Constitutional Amendment Bill for the GST has been tabled in Parliament. Corporate India, as expected, welcoming the development, saying this reform will help push India's GDP growth rate higher. Captains of Indian industry hope the bill will become a law soon, with all parties coming on board. Listen in.
Any movement forward on GST is cause for celebration. This is something which has been industry's ask. It has to be what India needs. It should be every Indian's ask, because all analysis shows that it will add 2% to the GDP of the country. So the ability to put this piece of legislation through has to be something which is supported across parties. It has been too slow in coming, and its time is now way past in terms of implementation. We need it, and we need all parties to come forward and support this going forward.
We are very enthused by the progress that has taken place, because certainly there seems to be a breakthrough between the finance minister and the states, which was the biggest stumbling block in taking the GST forward. Now, GST is something which is a long-term process. So, you know, if it's 1 month or 2 months here or there, it's probably not going to make so much of a difference, because in any case, the introduction, the earliest introduction, looks like 2016.
Well, after years of back and forth, the Constitutional Amendment Bill for the Goods and Services Tax finally keeps its date with Parliament. Now, growth is anemic amidst the government's mid-year economic review, and given the pathetic state of private sector balance sheets, the government will have to kickstart growth with public investments, which can in turn pull in private investments. The review, however, is hopeful that growth will improve in the second half of the year on the back of lower oil and commodity prices, though a cut in plan expenses will be a significant drag. Arvind Sukumar has the highlights of the mid-year review.
Team Modi's first 6 months in office may not have been all talk, but they have not been the blockbuster everyone expected either. The Indian economy in the April-September period has set the stage to end the financial year with a growth rate of 5.5%. That's at the lower end of the 5.4 to 5.9% growth projected earlier in the year. The silver lining, however, is that if this forecast holds true, it would mark an improvement from 2 successive years of sub-5% growth. Chief Economic Advisor Arvind Subramanian says growth should pick up in the remaining 6 months of the year, helped along by a favorable external environment.
India will have to find its own model for growth going forward, whether it's services or manufacturing, as the Prime Minister has emphasized. I think we'll have to find our own model, and we also have to find our own model in terms of our political system. So the China model doesn't readily travel to other countries.
On a further heartening note, the review projects that 7 to 8% economic growth is within reach in the coming years. For this, it banks on game-changing reforms like higher insurance FDI, the rollout of GST, and the direct benefit transfer. The review also notes that inflation has come down dramatically in the first 6 months of fiscal 2015 and pegs retail inflation between 5.1 and 5.8% in the next 5 quarters. The Chief Economic Advisor goes one step further, saying inflation will come as a pleasant surprise before the year ends.
Going forward, our own assessment is that these, what we call disinflationary impulses, which we see now in the data, are likely to persist going forward.
Subramanian is also confident that current account deficit, which has already shown signs of narrowing, will come down further over the coming quarters. The review expects India to close FY15 with a current account deficit of around 2% of GDP, with lower global oil prices offsetting a surge in gold imports. But the really big problem Finance Minister Arun Jaitley will have to grapple with is meeting the stiff fiscal deficit target of 4.1% of GDP, or 5.31 lakh crore rupees. Remember that by October, fiscal deficit had already touched 90% of this figure, giving the government very little room to maneuver. But experts say the government may still manage to squeeze past the finish line.
What India is trying to achieve in this budget is actually to try fiscal consolidation at a time when the economy is growing below its potential. We call this pro-cyclical fiscal policy, and it's somewhat unusual to pursue such policy, and very few countries are doing it at this time.
Of course, at this stage, meeting this target will mean sharp cuts in expenditure, which could hurt growth further. That's because tax revenue collections have fallen short of over-optimistic projections. But even here, the government may get some support from global oil prices.
Expenditure cuts, to the extent that they have to happen, will exert a drag on growth, but I think they will be offset by the fact that oil prices have come down. Reforms should spur investment and consumption as well. So I think there's a delicate kind of balance there, but on balance, the forces seeking to perk up growth will probably be stronger than the forces dragging growth via expenditure cuts.
Experts, however, are not that convinced with the review's arguments and projections when it comes to growth. They point out that the review bases its conclusions on data from the first 6 months of the financial year, 6 months that ended 3 months ago. So it does not take into account more recent developments like the fact that industrial production actually contracted at a shocking 4.2% in October, or the fact that key reforms like a hike in insurance FDI to 49% have still not materialized. In Mumbai, Arvind Sukumar.
And the pressure on the RBI governor to cut rates may be mounting, but he does have one person on his side. William Boutier, Citigroup's chief economist and former external member of the Bank of England's Monetary Policy Committee, says a central bank must disregard political pressures and remain cautious when it comes to reading inflationary signals and tweaking rates.
It's almost always the case that the political authorities are too hasty. They want to eat the cookies before they have been baked properly. And I would say make sure that it's not just headline inflation that is under control, but also underlying inflation, the trend inflation. With a likely future weakening of EM currencies, including the rupee, there will be external inflationary pressures, which at the moment are being masked by the weakness of commodity prices, especially oil. But as and when the US exits from its zero-rate policy, there will be downward pressure on the external value of the rupee as well. And I think the price stability and inflation targeting central bank will always be cautious.
Well, that's a bullish city view. Now, vital growth driver going forward, the government believes will be the Prime Minister's Make in India campaign. I spoke with a whole host of secretaries from various government departments a short while ago, and they all agreed that export pessimism is unwarranted at this point in time. This in the context of Make for India versus Make in India. They were also unanimous that the only way to achieve the ambitious 8% growth trajectory would be to give manufacturing a booster dose. Remember, our global share of manufacturing is 1.7%. This is what the Make in India campaign is specifically hoping to address. Take a look at some of the most important secretaries in the government of India on the Make in India campaign and what has been the progress so far and what can be expected going forward.
Still a lot of enthusiasm. There's still a lot of vibrancy. There's still a lot of dynamism. A number of things have been done. A number of things are work in progress. I personally feel that this government hasn't done anything wrong till now as far as the economic front is concerned. It's done a lot of right things. It's focused very, very strongly on ease of doing business in terms of scrapping processes, procedures. And I think if India is going to have sustained growth of high rates over a long period of time, India must become a far more easier place to do business. We had made it too complex and complicated. It's opened up FDI in a vast range of areas. Railway, which was unthinkable. Defense, it's deregulated almost 60% of the item. It has enhanced FDI inflows. Construction, very easy entry and exit, vast number of areas. It's focused also on infrastructure. There's a lot of work in progress. I mean, a lot of work in progress in terms of GST. There's a lot of work, Gauri has done a lot of work around labor. Yeah. There's a lot of work in progress around labor, land acquisition. So to my mind, there's a lot of work in terms of progress in terms of consistency and predictability of tax policy as well. To my mind, this government hasn't done anything wrong, but there are a number of legacy issues. And legacy issues in terms of land, in terms of tax, are very, very complex, very difficult. You'll have to give this government some more time, and I'm sure this government will get it right. The thinking is absolutely straight, it's linear, it's very market-oriented, and I have no doubt in my mind that over a period of time. You should also realize that we are in the midst of at a time when there is a global slowdown all around the world except partly America. But Japan, Europe, all are down. And I think you've got to view this against the global scenario. But irrespective of this, I think this government is bang on track.
Rajiv K, the Commerce Secretary, let me ask you, sir. Amitabh Kant here talking about drawing in investments, talking about predictability, certainty, and so on and so forth. Let's just look at the Make in India theme, since that's what we're ostensibly discussing here today. Let's look at the idea of trying to push manufacturing to 25% of GDP, which, by the way, was the target of the UPA government as well, and was unsuccessful. Currently, the share of manufacturing to GDP at about 16%. Let's look at only one aspect of the special economic zones, an idea that was floated by the previous government, and now instead of people queuing up for special economic zones, you have people queuing up to denotify special economic zones. Why can't the Commerce Ministry and the Finance Ministry get its act together as far as what you intend to do with special economic zones are concerned?
Well, thank you. First of all, to respond to your last point that you mentioned, why can't we see together towards a common objective? Let me tell you that the relationship between the Department of Commerce and Department of Revenue very often used to be very adversarial. But now I get more letters from my friend Secretary Department of Revenue promoting SEZs rather than my writing to him.
So has he agreed on your MAT demand, sir? Have you managed to convince him on your MAT demand?
Let me complete. That was the first point. Now clearly SEZs, there is a lot to be done. There is a lot to be done. MAT DDT is just one aspect, very important aspect. MAT DDT is an issue which needs to be addressed through the budget process. We can't preempt that process. We will have to wait till that point, and that's what we will do. But there are a whole lot of other issues which need to be addressed. And two or three issues which have been immediately addressed. One is, of course, which is a signal, which is an indicator, dual use of infrastructure which is created in non-processing areas. Now, this is something which was recently notified, and which is going to be notified. I'm sorry, it's not been notified, but we have reached a decision. Now, this is a clear indicator of the fact that we are talking in terms of optimizing infrastructure which is created in SEZ.
Okay.
And obviously, we are doing it to make SEZs workable. There is a significant amount of work which has been done on the issue of procedures and processes in SEZ. And if you go to an SEZ, you will see a distinct difference now. There is a whole lot of other things. I think the important thing is that how do we conceptualize SEZs? The SEZ-DTA relationship.
Right.
I think that is important because in the context of what Amitabh mentioned earlier, if you are talking of SEZs as manufacturing zones, not exclusively promoting exports alone, but manufacturing in India, I think we need to look at, in a much more comprehensive manner, the relationship between the SEZ and the domestic territory.
I
think that is very important.
I agree
so you need to look at a much larger bouquet of issues rather than just a few issues like
So in terms of the larger bouquet of issues, and I understand the sanctity of Parliament and the sanctity of the budget, and hence you're not going to give me a clear answer on whether we are going to see any relief coming in on MAT or not. 14,000 crores, I understand, is on stake as far as revenue from SEZs collected through the MAT route is concerned. But I'm guessing that there is some negotiation that may lead to a little bit of relief on that front. But give us a timeline of when we can actually see this holistic solution as far as the SEZ and the DTA issue is concerned.
See, there are two levels at which this is happening. One is the issues which have been on the agenda for some time, the issues of MAT DDT, dual use.
At least tell us if you managed to convince the Revenue Secretary.
MAT DDT, you will definitely see something on 28th of February.
We will definitely see it.
You will see an outcome. What it could be, nothing is done.
Fair enough.
Could be a lot is done. I don't want to preempt that.
Fair enough.
There will be a decision. Dual use will be notified very soon.
Okay.
There are issues relating to service tax. There are issues relating to procedures. So all of this will definitely happen before the budget.
Okay, let me come across to the Labour Secretary. Ma'am, the Labour Laws exemption from furnishing returns and maintaining registers by certain establishments Amendment Bill of 2011 has been passed. So congratulations on being able to get that done. What more can we really expect? Because every conversation that you have in a forum like this one or others, the big demand is until you actually reform labour laws in this country, we're not going to be able to achieve the manufacturing dream and the Make in India dream. What should we expect? How realistic should we really be when we talk about things like labour reform?
You overlooked mentioning the Apprentices Act, which I think is really a game changer.
My apologies. And the Unified Labour Portal, Shram Suvidha, and a Transport and Accountable Labour Inspection Scheme.
We always are the neglected lot, so never mind, Shireen. We'll accept that. For a long time we have believed, and you talked about expectation, you talked about managing expectations. I think it is maturity of expectations, Over a period of time, you understand that reforms can't be sequenced. You have to go for comprehensive, all-round reforms. And that means you have to have the big picture and you have to have the small blocks moving in that.
Let me get the Defence Secretary into this conversation, sir. As far as FIPB proposals are concerned, the defence sector is a sector where we actually have seen clearances coming in. Can you give us a sense of how many have been cleared? What is the total value in terms of the projects that have been cleared?
See, at this point of time, I will not be able to give you the full picture of what is emerging. But I can say that I have seen I've seen excellent prospects of FDI flowing in, because a large number of the companies in the advanced countries who want to make in India. This Make in India has actually caught their imagination, and a large number of companies are interested in. I don't mean companies, the ordinary type of companies. I'm thinking the high-end companies who are really interested in producing high-value products. They are interested in to come to India.
Okay.
But these dialogues are going on, because every day we keep meeting somebody, and in fact, I met a couple of people yesterday also. So many people are coming to us, and now we have to see, the problem with the investment is that we really don't have a model, because the private sector investments are probably something very new. If you look at the investment that has come into India in the last 10 years or so, I mean more than 10 years, it's just $5 million. It's a ridiculously low figure. Now, in order to increase this to something very significant, we have to be patient. And I'm very confident that in the new environment that we have, the new government that has come, and the new policies that we are floating, a large amount of foreign direct investment will flow into India. And I'm very confident that these will be areas which are maybe quite unprecedented.
A few of the country's top bureaucrats there on Make in India. With that, we're going to wrap up this edition of India Business Hour. Thanks for watching.
CNBC TV 18, celebrating 15 years of leadership.